Millions of people lose their money because they don't understand dividend investing. They start their dividend investing journey without learning the important fundamentals. The allure of dividends can mask their intricacies, leading many people to face financial losses due to a lack of understanding. Dividend investing involves more than merely selecting high-yield stocks. It demands a comprehensive grasp of market trends, company performance, and economic shifts. Goldie does not want to become a statistical failure and will be focused on understanding the traps to avoid and how to make smart investments in this video to help her generate passive income, reduce market risk, and benefit from dividend tax advantages. Be sure to watch until the end, no matter your age, because we know for a fact this specific video will provide tremendous value. We will actually show you and Goldie how a dividend ETF with a low yield of 1% can outperform a high-yield dividend ETF of 7%. If you feel like you're missing out on bigger dividend returns, it's time to fix that. Subscribe now and revolutionize your dividend investing game. Don't let these dividend mistakes drain your profits. Join Goldie and our growing cash flow friend community for expert insights that could transform your portfolio. Hit that subscribe button and let's maximize those dividends together. To start, Goldie needs to understand why dividend investing is appealing for millions of people globally. To be frank, there are truly 6 key reasons. Let's power through them first. The 6th key reason is that dividend investing provides a steady income stream. Dividend-paying stocks provide a consistent source of passive income. Investors, particularly those nearing retirement or seeking supplementary income, find this cash flow appealing as it can help cover living expenses or be reinvested for growth. The 5th key is dividend investing provides a lower risk perception. Dividend-paying companies tend to be well-established and financially stable. Their ability to consistently distribute dividends can indicate a level of stability, making them less volatile and appealing to risk-averse investors. On to the 4th key reason, dividend investing yields compounding returns. Reinvesting dividends can lead to compounding returns over time. This means that as dividends are reinvested to purchase more shares, those additional shares also generate dividends, creating a snowball effect that accelerates wealth growth. And the 3rd reason is near and dear to many people right now. Dividend ETFs, or stocks, allow you to hedge against inflation. Dividend payments often increase over time, which can help offset the eroding effects of inflation. Companies that regularly raise their dividends are likely to adjust payouts to keep up with rising costs, providing a buffer against the diminishing value of money. On to our 2nd key reason, long-term investment strategy. Dividend investing encourages a long-term perspective. Investors like Goldie, who focus on companies with a history of consistent dividend payments, tend to think beyond short-term market fluctuations, fostering a disciplined approach to investing. And the number 1 key reason dividend investing is appealing is that it offers a diversification strategy. Many dividend-paying stocks belong to established sectors, such as utilities, consumer goods, and healthcare. This can lead to a diversified portfolio, spreading risk across different industries and potentially reducing the impact of sector-specific downturns. As you digest these 6 key reasons that investors love dividend investing, it's important to remember that investors are often enticed by the promise of consistent payouts, so they dive into dividend-focused ventures without considering factors such as dividend sustainability, payout ratios, and the company's overall health. Failing to recognize that dividends can fluctuate or be suspended during economic downturns can lead to unexpected financial setbacks. Furthermore, the interplay between dividend yield and stock price isn't always straightforward, and a myopic focus on yield can neglect the crucial aspect of capital appreciation. So let's provide Goldie a well-rounded comprehension of dividend investing, necessitating awareness of a company's dividend history, its sector dynamics, and broader market trends before she makes the same mistake that millions of others have previously made when they started their dividend investing journey. These interconnected elements converge to shape the potential returns and risks associated with dividend investments. At the heart of dividend investing lies a company's dividend history. This historical data encapsulates the company's track record for distributing a portion of its profits to shareholders. Analyzing this history offers valuable insights to the company's financial stability, management's commitment to shareholder value, and its ability to generate consistent cash flows. Companies with a reliable history of dividend payments are often indicators of mature and financially sound businesses. AbbVie, is a renowned global biopharmaceutical company that has gained attention not only for its innovative healthcare products, but also for its dividend history. Formed as a spin-off from Abbott Laboratories in 2013, AbbVie has a relatively short but impressive dividend track record that showcases its commitment to rewarding shareholders through consistent payouts. Since its inception, AbbVie has prioritized dividend payments as a means to deliver value to its shareholders. Its dividend history exemplifies a pattern of regular increases, reflecting the company's financial strength and stability. This approach has garnered the attention of income-seeking investors looking for opportunities in the healthcare sector. From 2013, AbbVie has increased its annual dividend return from 40 cents per share to $1.48 per share. As you and Goldie can see, the consistency of dividend payments speaks to the management's confidence in the company's future prospects, a sentiment that can bolster investor trust. However, a deeper exploration extends beyond the company's dividend track record to encompass sector dynamics. Each sector within the market presents unique challenges and opportunities that impact dividend-paying companies differently. For instance, AbbVie operates within the dynamic pharmaceutical and biotechnology sector, specializing in research-driven healthcare solutions. AbbVie focuses on immunology, oncology, neuroscience, and other therapeutic areas. As a key player in the biopharmaceutical field, the company's sector dynamics are characterized by rigorous research and development efforts, regulatory scrutiny, and competitive pressures. The demand for innovative treatments, coupled with the potential for patient expirations and regulatory shifts, influences AbbVie's strategic decisions and market positioning. Navigating this sector requires adaptability, a strong pipeline, and a commitment to delivering breakthrough therapies that address global health challenges. Understanding these sector-specific nuances is pivotal for investors to align their expectations with the realities of the market. Furthermore, incorporating knowledge of broader market trends amplifies the depth of comprehension in dividend investing. The broader market has a significant impact on AbbVie, as it does on many other companies. AbbVie's performance is influenced by various factors related to the overall economic and market conditions. As market sentiment sways like a pendulum, AbbVie's stock price sways in tandem. Investor sentiment and overall market trends can impact AbbVie's stock price. During periods of market optimism, stocks like AbbVie might see increased demand, leading to potential price appreciation. Conversely, during market turndowns, stocks can experience declines, including AbbVie. In addition, economic conditions such as GDP growth, inflation, and interest rates can influence AbbVie's financial performance. Economic growth often correlates with increased healthcare spending, benefiting pharmaceutical companies. Interest rate changes can impact borrowing costs and investment decisions, affecting both AbbVie and its investors. And don't forget the importance of the regulatory environment. Broader market trends can influence regulatory dynamics in the pharmaceutical sector. Changes in healthcare policies or regulations can impact AbbVie's product development, pricing, and market access. It's vital to remember that as the market sways, an investor's risk appetite sways. In times of market volatility or uncertainty, investors might shift toward more defensive stocks, such as healthcare companies like AbbVie. Conversely, during periods of market stability and growth, investors might be more willing to take on riskier investments. And lastly, we must look at the macro picture, because AbbVie's operations extend globally. Global trade and geopolitical events can generate tensions, geopolitical conflicts, and international market dynamics that can impact the company's revenue, supply chain, and market access. Navigating these intricate layers of dividend investing requires a proactive and analytical approach. Scrutinizing a company's financial health, evaluating its payout ratio, or the proportion of earnings distributed as dividends, and examining its dividend growth rate over time provides essential quantitative insights. Yet qualitative aspects also play a pivotal role. Analyzing a company's business model, competitive advantage, and management's strategic vision adds another dimension to the assessment. By combining these quantitative and qualitative aspects, investors can make more informed decisions about the sustainability and potential growth of dividends. So we've discussed many of the qualitative components of dividend investing. Let's help Goldie apply this newfound knowledge and show you and Goldie how a dividend ETF with a low yield of 1% can outperform a high-yield dividend ETF of 7%. She wants to invest $25,000 as her initial investment. Remember, you can start with only a few $100s or a few thousand. So Goldie plans to invest $25,000 and wants to hold her ETF for 10 years. We're going to show her what would happen if she invested in SCHD, versus PFF, both reputable dividend ETFs. SCHD has an individual dividend yield of 1%, average annual dividend growth rate of 6%, and an average annual capital appreciation of 8%. For SCHD, the combined average annual return is 6%, dividend growth, plus 8% capital appreciation, which equals 14%. After 10 years, the compound interest formula yields a total return of $61,306. On the other hand, PFF has an individual dividend yield of 7%, an average annual dividend growth rate of 2%, and an average annual capital appreciation of 4%. For PFF's calculation, we'll use the same formula. The combined average return for PFF is 7% individual dividend yield, plus 2% dividend growth, plus 4% capital appreciation, for a total of 13%. However, for PFF, after 10 years, the compound interest formula returns $39,979. These calculations illustrate how compounding works over time. Both ETFs teach us valuable lessons. The potential for growth is a formidable force, and the pursuit of sustainable returns requires considering the full orchestration of investment components. As Goldie mulls over her two options, she is reminded that dividend investing is not only about dividend yield. Dividend yield alone fails to capture the comprehensive picture of an investment's potential. A high yield might seem appealing, promising immediate income. However, a laser focus on yield can blind investors to other essential aspects. Companies with exceptionally high yields might be struggling or facing uncertainties, putting their ability to sustain dividends at risk. Conversely, companies with lower yields may be strategically reinvesting profits to fuel growth and ultimately offer stronger returns over time. Investors must embrace a holistic perspective, considering factors like dividend growth history, earnings, sustainability, and overall financial health. Balancing dividend yield with dividend growth potential, capital appreciation, and company fundamentals is the key. The mantra should be quality over quantity, selecting companies with a track record of consistent dividends, healthy earnings, and a strong market position can lead to more robust long-term returns. By broadening her view beyond dividend yield, Goldie can navigate the complex landscape of investments more wisely, seeking both immediate income and the promise of sustained growth. Remember, dividend investing is appealing for three main reasons. First, providing income generation. Dividends offer a regular stream of income, providing investors with tangible returns, even in volatile market conditions. This consistent cash flow can be particularly appealing to retirees and those seeking supplementary income beyond capital appreciation. Second, dividend investing offers risk reduction. Dividend-paying companies often exhibit a level of stability and financial strength that enables them to share profits with stakeholders. Investing in such companies can provide a buffer against market downturns, as they tend to weather economic challenges better than non-dividend-paying stocks. And third, dividend investing allows you and Goldie to lower your tax impact. Dividends often benefit from preferential tax rates, especially in comparison to other forms of investment income, like interest or short-term capital gains. This can result in potentially lower tax liabilities for investors, making dividend investing a tax-efficient strategy. To maximize the value from dividends, employ strategies like reinvesting dividends, selecting growth-oriented dividend stocks, diversifying across sectors, and maintaining tax efficiency. Focus on companies with a history of dividend growth, avoid chasing high yields without due diligence, and consider a long-term perspective for compounding gains. Regularly review your portfolio, and remember that sound research and consultation with a financial advisor are crucial for successful dividend investing. But don't let your dividend journey end here. The excitement of learning can continue. If you're eager for more expert insights on boosting your wealth and perfecting your dividend approach, don't forget to hit that subscribe button and turn on notifications. In our upcoming video, we delve into the world of the dividend snowball and unveil the fastest way you can live off dividends and retire early.